This video provides a basic overview of variances. Variances are simply the difference between two numbers. For instance, the number 63 and the number 40. We would say the variance is $23. In particular, in our example, we're going to consider what we might have planned to spend for gasoline during a current month of $40 compared to what we actually spent of $63. And our question then becomes, why did we spend more and how might we interpret that variance? The first thing we're going to observe is that whenever we spend more than we originally planned, we say we have an unfavorable variance because higher costs would decrease a firm's net income. Pause this video for a second and consider what factors might cause us to spend $63 or rather $23 more in gasoline than we had originally planned. You should be able to think of 3 reasons for that. Again, pause the video and give it a thought. One reason we might have spent more is a price variance. We might have paid more per gallon of gas. A second reason is that we might have found that we drove more miles than we had expected. We're going to refer to that as an activity variance. The third reason might have to do with fuel efficiency. Our car might have gotten worse or even better miles per gallon than we had originally anticipated. So again, we're going to say that we've got 3 different reasons why we might have spent more than we had expected. 1 would be a price variance, 2, a quantity variance, or 3, an activity variance. Let's now dig a little bit further and explain or explore why we had this $23 total variance. As a first step, let's be sure we understand where the original $40 came from. We would have had an original plan to drive a certain number of miles, in this case 500 miles. And if our car got 25 miles per gallon, we would have expected to purchase 20 gallons of gas. We refer to this 20 gallons as our standard quantity. We would have also multiplied that standard quantity by an expected price for gas, or a standard price, which in this case was $2 per gallon, and that's how we would have come up with the $40 originally planned for gasoline expenditures. Now during the month, it turns out that we drove far more miles than anticipated. We drove 900 miles during the month. We actually, however, got better gas mileage. Perhaps we drove more highway miles, which of course would increase the number of miles and probably improve our fuel efficiency. But in any event, we got 30 miles per gallon, which means we had to purchase 30 gallons of gas. We'll refer to that as our actual quantity. We can then back into an actual price that we paid by taking the $63 we spent on gasoline, divide by 30 gallons, and we see we had a $2.10 per gallon price. Getting a little bit ahead of ourselves, we can expect then that we will have an unfavorable price variance because we spent more per gallon than we had anticipated. But that's getting a little bit ahead of ourselves. The first step we need to take in preparing or evaluating this $23 variance is to prepare a flexible budget or a revised budget. Our flexible or revised budget considers our actual number of miles that we drove. Again, we actually drove 900 miles. Well, if you had told me up front we were going to drive 900 miles, how much would we have expected to spend for gas? Recall, we expected to have 25 miles per gallon, which means we would have expected to purchase 36 gallons of gas. At a $2 per gallon budgeted price, we would have expected to spend $72 in gas. So we can see our flexible or revised budget amount based on 900 miles is certainly higher than what we would have budgeted for 500 miles. The difference between this 72 and this 40 is a $32 activity variance, which in this case is unfavorable because the $72 in our revised budget amount based on a higher level of activity, of course, results in higher cost than if we had only driven 500 miles. And again, anything that improves or increases our cost we refer to as an unfavorable variance. Be careful in interpreting this because you can quickly see if we didn't drive any miles, we wouldn't have spent anything on gas and we would have had a favorable variance. Now, if we're an Uber driver and we don't drive any miles, I certainly wouldn't say that a favorable activity variance is good for business. So again, unfavorable and favorable variances need to be carefully interpreted. Unfavorable simply means something that would have caused cost to increase. So we've isolated the first part of that $23 difference is related to a $32 unfavorable activity variance. Now let's consider the difference between our actual $63 expenditure and what we would have expected to spend had we known we were going to drive 900 miles. That difference is referred to as a spending variance, and we can easily calculate our spending variance and see that it was $9. And we would say it's a favorable variance because we ended up spending $63, which is $9 less than we would have expected to spend had we known we were going to drive 900 miles. Let's now break this $9 favorable spending variance down into two components, a price variance and a quantity variance. We had already suggested that our price variance would be unfavorable because we paid more per gallon. We're going to find our quantity variance will be favorable because we used fewer gallons than we would have expected. But let's work on those calculations. So we take our actual gallons purchased, 30 gallons, and if we had paid our $2 per gallon standard or expected price, we would have anticipated only spending $60 in gas. We did spend what? $63 in gas. And so that gives rise to the $3 unfavorable price variance. And we can see that simply the 30 gallons multiplied by an extra 10 cents per gallon. Our quantity variance then is the difference between the 60 and the 72. We had a $12 quantity variance and it was favorable. Why is it favorable? Because we would have expected to purchase 36 gallons of gas if we had known we were going to drive 900 miles. We only purchased 30 gallons of gas. So we have a favorable quantity variance. And we can see we could have calculated that $12 as the difference in quantity, 6, which is the 36 minus the 30, times $2 per gallon. So we've been able to break down this total unfavorable variance into three components: a price variance, a quantity variance, and an activity variance. Notice we have a $32 unfavorable activity variance, a $3 unfavorable price variance. That's a total of 35. And 35 minus 12 gives us the $23 total unfavorable variance. Our spending variance of $9 was composed of two components: a $3 favorable variance, which helped to offset $3 unfavorable variance, which offset part of the $12 favorable quantity variance. When you're talking about your variances, try not to focus on the difference between these two, in other words, a favorable or unfavorable, but really our spending variance is favorable because we spent 63 and we would have expected to spend 72. It just so happens that these two pieces combined equal our total spending variance.